So first I would introduce our business idea, which is Zero Gravity, and simply it is a ride, and it's considered to be in the entertainment and attractions industry. Next up is talking about our target segment. So the total population in Egypt is 90 millions, and we are targeting the A and B class, which is around 20% of the total population. So our target now is segmented to be 18 million, and our age segment is from 14 to 35. So our target is 20% of the A and B class according to the age segment. So we're targeting around 3.6 million, and then we assume that 30% of those would be interested in our service. So at the end we'll be targeting around 1 million to serve.
We assume that we will have 8,320 customers per year. Our growth rate for the first year will be 50%, and it will follow the fluctuating business cycle trend. Our growth rate will increase in an increasing rate till we reach the third year, and then it will decrease after that until we reach year 6, and then we'll introduce a new service. The forecasted income statement. Our sales, we got our sales by multiplying the number of forecasted tickets times the price of the ticket, which we multiplied the forecasted number of tickets, which was 8,320 times the price, which is 135, and we got 1,123,000. So then we subtracted the cost of sales, and we got a gross margin of 1,044,000. Then our rent equipment was 400,000, and we rented the location for the first year with 120,000. The transportation we used for moving the game cost us 12,500, and we paid an insurance of 41,600. We paid 2,000 per month for the e-marketing, and this summed up with 24,000 per year. Our total operating expenses is 600,000. Our EBITDA, earnings before interest, taxes, depreciation, and amortization, was 444,000. Then we subtracted the depreciation and the amortization, which is 12,500. We got our EBIT by 431,000. Then we subtracted the interest, which represented 10% of our total, which we got 411,000, which is our earnings before taxes. Then we subtracted the taxes, which represents 20%, and we got our net income of 323,000.
For the forecasted balance sheet, we have assets. We have the current assets, which is the cash account, and we have the net plant and equipment, which is the office we bought, minus depreciation and amortization to get the total assets. Then we have the liabilities. We have current liabilities, accounts payable account. Then we have equity, which is the shareholders' equity, which our group invested, and then the returned earnings from operation to get the total equity, and then we calculated the total equity and liabilities. And for the cash flow statement, we have cash in and cash out. Starting the cash in, we have beginning cash, which is the amount we invested from our profit. Then we add to it sales income, and then we add loans to get the total cash in. And for the cash out, we have cost of sales, total other operating expenses, loan payment, which is interest, capital expenditure, tax payment, and then we calculate the total cash out to then calculate the net cash flow.
And then we calculated the free cash flow using this formula. In the table, we got the EBIT plus amortization plus depreciation to get the EBITDA. And then we deducted from the EBITDA the taxes. And then we minus change in working capital minus capital expenditures. And then we did it for all the years, and we added the forecasting of year 6 because we used it in the PV residual. And these are the following numbers we got for the free cash flow for each year.
When calculating the WACC, which is the weighted average cost of capital that resembles the average rate of raising money for a startup in our case, there are two parts involved in the equation. First is the debt, and the second is the equity. The debt part is calculating using interest rate times amount of debt times 1 minus taxes. Interest rate, which is 10%, times amount of debt, which is 24%, times 1 minus 20%, which is taxes. It will equal to 1.92%. The second part is the equity part. Is calculated through getting the risk-free rate and adding it to beta times market premium times the amount of equity. The risk-free rate is 10.20%. Beta times market premium will equal to 0.0688 times amount of equity, which is 76%. It will add up to 12.98%. It will, by adding the debt part to the equity part, we will end up with a WACC of 14.90%. Following, we will calculate the discounted cash flow by adding the cash flow for each year over 1 plus the discount rate to the power of the year, and adding all the years together, all the 5 years together, we will end up with the present value of free cash flow 723,260 Egyptian pounds.
Okay, so in order to calculate the PV residual, we had to plug in the numbers we got into the equation, which is year 6 FCF over the discount rate minus growth rate over 1 plus discount rate times number of years, which is 5. And in order to be more specific, the year 6 FCF that we got was 421,725, and the growth rate was 10%. And the WACC was 14.90%, and the PV residual that we got was around 4 million. And then in order to calculate the value of the company as a whole, we had to add the PV FCF to the PV residual, and we got around 5 million. So the value of our company is actually around 5 million.
This is a graph that compares theme park valuation. It compares the valuation of Walt Disney, Six Flags Entertainment Corporation, and Cedar Fair. And basically, as we can see, the industry that we chose to invest in with our startup is growing, and this is a good indication for the future of our startup. Thank you.